You check your portfolio and your stomach drops. Another sea of red. Down 2%, 5%, some stocks even 10% in a single day. I still remember the first time I watched my portfolio plummet during a market correction. It was 2018, and I'd convinced myself I was a genius investor after riding the post-2016 wave. Then reality hit hard. That sinking feeling in my stomach, the urge to sell everything, the sleepless nights. Sound familiar? What we're experiencing right now isn't just your typical market fluctuation. We're facing a perfect storm of economic pressures. Aggressive new tariffs are disrupting global supply chains. Economic growth is slowing quarter by quarter. The once robust labor market is showing cracks. And geopolitical tensions are creating ripple effects across every industry. But here's what separates successful investors from the rest. They don't panic when markets turn hostile. They adapt. When fear grips the market, your instinct might be to cash out completely. But history has taught us something powerful. Those who maintain strategic positioning during downturns don't just survive. They emerge stronger when markets eventually recover. The question isn't whether you should stay invested. The question is, how do you position your portfolio to weather the storm while maintaining the potential to capitalize when skies clear? Today I'm going to show you 3 elite ETFs that form a powerful defensive triangle for your portfolio. These aren't just random picks. They're strategic positions designed to provide stability, income, and protection during market turbulence. These 3 ETFs have consistently demonstrated resilience during previous market corrections, and they're perfectly positioned for the challenges we're facing right now. Before I reveal these portfolio saviors, take a second to hit that like button and subscribe to the channel. It helps more than you know, and it ensures you never miss critical market insights like these. Now, let's take a clear-eyed look at exactly what we're facing in today's market, before I show you how to defend against it. The market reality check. Let's be honest about what we're facing today. This isn't just routine market volatility. We're navigating through some serious economic headwinds that demand our attention. First, we have the new wave of tariffs being implemented across multiple sectors. These aren't just political talking points. They're having real impacts on corporate profits as companies scramble to adjust their supply chains and pricing strategies. When a company suddenly faces a 10% or 25% tariff on imported components, those costs eventually flow through to their bottom line, and to you, the investor. Beyond tariffs, the broader economic landscape is showing concerning signs of deceleration. GDP growth has been trending downward for 3 consecutive quarters. Consumer spending, which accounts for roughly 70% of our economy, is showing signs of fatigue as savings rates dwindle and credit card debt hits all-time highs. The manufacturing PMI has dipped below 50, indicating contraction in a sector that's historically been a bellwether for economic health. Perhaps most concerning is what's happening in the labor market. After years of robust job creation, we're seeing a steady increase in layoff announcements across technology, finance, and manufacturing sectors. Initial jobless claims have risen for 6 consecutive weeks. The unemployment rate, while still relatively low by historical standards, has begun ticking upward, a trend that rarely reverses without economic pain. Then there's the geopolitical backdrop. Tensions in critical regions are affecting everything from energy prices to semiconductor supply chains. Add to this mixture the uncertainty of an election year, and you have the perfect recipe for market anxiety. History shows that markets hate uncertainty above all else, and right now, uncertainty is exactly what we're facing. This isn't meant to frighten you, it's meant to prepare you. Understanding these realities allows us to position our portfolios defensively while maintaining long-term growth potential. The average investor makes the critical mistake of waiting until the market has already collapsed before taking action, or worse, panicking and selling at the bottom. Smart investors recognize the warning signs early and make strategic adjustments. They don't try to time the market perfectly, but they do understand how to shift their allocation to weather changing conditions. This brings us to the critical question. Is your portfolio properly diversified for what lies ahead? Have you built in defensive positions that can perform well during market stress? Or are you overly exposed to the high-growth, high-volatility names that led the market higher but could lead it lower just as dramatically. Now let's turn our attention to the first of our 3 defensive ETFs, a fixed income powerhouse that can provide both stability and income during uncertain times. ETF number 1, iShares 20+ year Treasury Bond ETF. When market turbulence hits, investors have historically turned to one asset class above all others: bonds. And today, I want to focus on one of the most powerful bond ETFs available to retail investors, the iShares 20+ year Treasury Bond ETF, ticker symbol TLT. This isn't just any bond fund. It's specifically designed to capture the performance of long-term U.S. Treasury bonds. Why does this matter right now? The relationship between bonds and interest rates creates a unique opportunity in our current economic environment. When uncertainty rises, investors typically flee to the safety of U.S. Treasury bonds, driving their prices higher. And when bond prices rise, their yields fall. But there's a more strategic reason why TLT makes particular sense in today's environment. Let's talk about something that doesn't get enough attention in financial media: the mountain of national debt we're currently facing. We're looking at interest payments alone approaching $1 trillion over a 12-month period. That's not the total debt. That's just the interest payment on our debt. This situation is becoming unsustainable, and it's creating enormous pressure on the Federal Reserve and administration to find a path toward lower interest rates. Here's where it gets interesting for TLT investors. When interest rates fall, bond prices rise, particularly for longer duration bonds like those held in TLT. This creates a potential double benefit. You get the current yield of 4.16%, plus the potential for share price appreciation as rates potentially move lower. It's this dynamic that makes TLT so attractive as a defensive position right now. Think about the scenarios ahead of us. If market volatility continues or worsens, more investors will likely seek the safety of Treasury bonds, potentially pushing TLT's price higher. If economic conditions deteriorate enough to prompt the Federal Reserve to cut rates, TLT benefits directly through price appreciation. And even if the economy stabilizes, you're still collecting that attractive 4.16% yield while you wait. I'm particularly interested in TLT at price points below $90, where the risk-reward proposition becomes even more favorable. What makes this ETF such an effective portfolio stabilizer is that it tends to move counter to the stock market during periods of stress. On days when your equity positions are bleeding red, TLT often provides a green counterbalance. Now, I'm not suggesting you should move all your assets into TLT or bonds in general. That would be an overcorrection that could limit your upside when markets eventually recover. Instead, consider TLT as one cornerstone of your defensive positioning, a place to park some of your portfolio that can provide both income and potential appreciation during market uncertainty. For those of you wondering about the risk factors, the main one to consider is that if inflation suddenly spikes higher, or if interest rates unexpectedly rise rather than fall, TLT would face headwinds. But given the current economic trajectory and the pressure to address our massive debt burden, I believe the probabilities favor TLT investors in the months ahead. Now let's move on to our second defensive ETF, one that bridges the gap between defensive positioning and equity exposure. ETF number 2, Schwab U.S. Dividend Equity, ETF. When markets get turbulent, investors often seek refuge in companies that share their profits directly with shareholders through dividends. This brings us to our second defensive ETF, the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. And the timing couldn't be better, as SCHD has recently undergone a complete transformation that positions it perfectly for today's challenging market environment. SCHD just completed its annual reconstitution, and the changes are significant. If you look at the sector breakdown now, energy has taken the top spot, accounting for 21% of the ETF. Consumer staples follows closely at 19%, healthcare at 15%, industrials at 10.5%, and technology now sits at just under 10%. Notice something about the top 3 sectors. Energy, consumer staples, and healthcare are all traditionally defensive sectors that tend to hold up better during economic downturns. This is no accident. The ETF's methodology is designed to identify companies with strong fundamentals, consistent dividend payments, and solid financial health. In uncertain times like these are exactly the qualities you want in your equity holdings. Let's look at the top holdings after this reconstitution. ConocoPhillips and Chevron, two energy giants, now sit at the top of the portfolio. They're followed by Verizon Communications, Coca-Cola, Bristol-Myers, Altria Group, PepsiCo, Amgen, Cisco Systems, and AbbVie. In total, SCHD holds 104 positions, with the top 10 accounting for 40% of the fund. These aren't speculative growth companies. They're established businesses with strong cash flows and a commitment to returning capital to shareholders. What makes SCHD particularly powerful is that it offers a dual benefit that pure bond investments like TLT can't match. You get immediate income through its solid 3.77% dividend yield, but you also get growth potential, both in share price and in the dividend itself. SCHD has delivered a 5-year dividend growth rate of 11.44% and boasts 13 consecutive years of dividend growth. Think about that. While inflation has been eroding the value of static income sources, SCHD investors have been getting annual raises well above the inflation rate. This combination of current income and growth gives SCHD a unique advantage over purely defensive plays. If markets continue to struggle, the defensive sector allocation and dividend income provide a buffer against volatility. But if markets stabilize or recover, you'll still participate in the upside through share price appreciation, unlike with bond investments that have more limited upside potential. There are 3 strategic ways to incorporate SCHD into your portfolio. First, you can use it as a core equity holding, providing exposure to quality dividend stocks while reducing overall volatility. Second, you can pair it with growth-oriented ETFs to create a barbell approach that balances income and growth. Third, you can use it as part of a dividend reinvestment strategy, compounding your position during market downturns to accelerate wealth building when markets recover. When combined with our first ETF, TLT, you're building a foundation of income and stability while maintaining exposure to quality equities. But our defensive triangle isn't complete yet. Let's move on to our third ETF, which provides protection of a completely different kind. ETF number 3, SPDR Gold Shares ETF. Throughout human history, one asset has consistently served as a safe haven during times of economic uncertainty: gold. And that brings us to our third defensive ETF, the SPDR Gold Shares ETF, ticker symbol GLD. This ETF offers a convenient way to add gold exposure to your portfolio without the hassle of physical storage or security concerns. Gold's performance during recent market volatility has been nothing short of remarkable. Over the past 12 months, GLD has delivered a staggering 40% return, completely trouncing the S&P 500's modest 7% gain. Even more impressive is its 3-year performance, where GLD has climbed 60% compared to the S&P 500's 22% return. And this follows 2 years of 20% plus growth for the broader market, making gold's outperformance even more notable. What makes gold such a powerful defensive asset? Unlike companies that need to meet earnings expectations or provide forward guidance, gold doesn't have to prove its worth through quarterly reports. It's a finite resource that has maintained its value for thousands of years. Gold doesn't erode, it doesn't go bankrupt, and it doesn't face management scandals. In times of uncertainty, these qualities become incredibly valuable to investors. The past year has seen record buying of gold across multiple fronts. Central banks globally have been accumulating gold at the fastest pace in decades, reducing their dependence on traditional reserve currencies. Institutional investors have been adding gold allocations as a hedge against both market volatility and currency devaluation. And retail demand has surged as economic concerns have grown. Gold serves as what I call the sleep-at-night asset in your portfolio. When market volatility has you tossing and turning, knowing that a portion of your wealth is protected in an asset that has maintained value through wars, depressions, and currency collapses provides psychological comfort that can help prevent panic selling of your other assets. While gold is currently trading near all-time highs, the economic and geopolitical backdrop suggests continued support for prices. supply constraints in gold mining, increasing production costs, and declining discovery rates of new deposits all point to potential supply limitations in the face of growing demand. Some investors question adding gold when it's already had a significant run-up, but consider this historical perspective. During previous periods of economic stress and monetary uncertainty, gold has often seen its most dramatic price increases after already reaching what seemed like high levels. During the 2008 to 2011 period, gold continued to climb even after setting new records. How much of your portfolio should you allocate to GLD? This varies based on your risk tolerance and investment timeline, but many financial advisors suggest somewhere between 5 to 15% as a reasonable allocation. This provides meaningful protection without overly restricting your growth potential. When combined with our bond ETF, TLT, and our dividend ETF, SCHD, GLD completes our defensive triangle, offering protection against market volatility, currency concerns, and geopolitical uncertainty. Each of these three ETFs approaches defense from a different angle, creating a diversified protective strategy that can help your portfolio weather the current storm. Now that we've explored our three defensive ETFs, let's talk about how to implement them strategically in your portfolio. The exact allocation will depend on your individual risk tolerance, time horizon, and current market exposure. But here's a framework to consider. If you're extremely concerned about near-term market volatility, you might allocate 40% to TLT for bond stability, 40% to SCHD for quality equity exposure with income, and 20% to GLD for inflation protection and crisis insurance. For more moderate protection, consider 30% TLT, 50% SCHD, and 20% GLD, which maintains greater equity exposure while still providing meaningful defense. Remember, these allocations aren't meant to represent your entire portfolio. They form a defensive portion that complements your existing strategy. The key is to implement these positions methodically, perhaps through dollar-cost averaging, rather than all at once, especially given current market volatility. What makes this 3 ETF approach so powerful is its efficiency. With just 3 positions, you're gaining exposure to treasuries, over 100 quality dividend stocks, and gold, all with expense ratios well below industry averages. This means more of your money stays invested rather than going to fund management fees. As market conditions inevitably change, rebalancing between these positions becomes important. If one area significantly outperforms, don't hesitate to trim and reallocate to maintain your target defensive allocation. Look, I'm not telling you that a market crash is imminent, nor am I suggesting you should panic and sell everything. What I'm advocating is thoughtful, strategic positioning that acknowledges the reality of our current economic situation while maintaining the flexibility to participate when markets recover. These 3 ETFs, TLT, SCHD, and GLD, provide a powerful defensive triangle that can help you navigate these uncertain times with confidence. They've proven their worth during previous periods of market stress, and they're perfectly positioned for the challenges we're facing today. I'd love to hear which of these 3 ETFs resonates most with your investment strategy. Are you leaning toward the safety of bonds with TLT, the dividend growth potential of SCHD, or the crisis protection of GLD? Let me know in the comments below. If you found value in today's analysis, please take a second to hit that like button. It makes a tremendous difference in helping others find this content. Subscribe to the channel and hit that notification bell so you don't miss our upcoming videos on portfolio protection strategies in specific sectors that could outperform in the current environment. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Investments carry risk and you may lose money. Thanks for watching.